Well, good morning, everyone. Bonjour tout le monde. My name is Paul Bodicher. I'm the Director of Media Relations here at the Bank of Canada, and I'll be moderating this press conference about today's interest rate announcement, the first such press conference without a monetary policy report, so I'd like to welcome everyone on this occasion. Le gouverneur Macklem va prononcer une déclaration préliminaire et après on va tourner vos questions. After his opening statement, Governor Macklem and Senior Deputy Governor Carolyn Rogers will be happy to take your questions. So without ado, I'll turn it over to Governor Macklem for his opening remarks.
Well, thank you, Paul, and good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss today's policy decision. This is the first time we're speaking to you on the day of a policy decision that is not accompanied by a monetary policy report, so it is a little different from what we're all used to. We want households, businesses, and communities to understand the actions we're taking and why. So we're answering questions at every decision as part of our commitment to keep Canadians fully informed. Our quarterly MPRs include a full economic outlook. Our deliberations this time were based on how the economy and risks to the outlook have evolved compared to what we expected in January. In the 6 weeks since our January decision, there have been no big surprises. Economic growth has remained weak and inflation has eased further as higher interest rates restrain demand and relieve price pressures. But with inflation still close to 3% and underlying inflationary pressures persisting, the assessment of the Governing Council is that we need to give higher interest rates more time to do their work. With that in mind, the Governing Council decided to maintain the policy interest rate at 5%. We're also continuing our policy of quantitative tightening. In January, we indicated that our confidence had increased that our policy rate was high enough to restore price stability. And while we could not rule out the need to raise rates further if there were new inflation surprises, we indicated that our discussions were shifting from whether our policy rate is restrictive enough to how long it needs to stay at the current level. Today's decision reflects the Governing Council's assessment that a policy rate of 5% remains appropriate. It's still too early to consider lowering the policy interest rate. Recent inflation data suggests monetary policy is working largely as expected, but future progress on inflation is expected to be gradual and uneven, and upside risks to inflation remain. Governing Council needs to see further and sustained easing in core inflation. Depuis notre décision de janvier, il n'y a pas eu de grandes surprises. La croissance est restée faible et l'inflation a encore diminué parce que les taux d'intérêt plus élevés ont limité la demande et allégé les pressions sur les prix. Mais l'inflation est encore près de 3% et des pressions sous-jacentes persistent. C'est pourquoi le Conseil de direction pense qu'il faut laisser aux taux élever plus de temps pour produire leurs effets. Le Conseil a donc décidé de maintenir le taux directeur à 5%. Et la Banque poursuit sa politique de resserrement quantitatif. En janvier, on a dit être plus confiante que le taux directeur était assez élevé pour rétablir la stabilité des prix. On ne pourrait pas exclure d'autres hausses de taux si l'inflation remontait de façon imprévue. Mais on a dit que nos discussions seraient orientées. La question n'était plus tellement de voir si le taux directeur était assez restrictif pour ramener la stabilité des prix, c'était plutôt de voir combien de temps il faudra le maintenir au niveau actuel. La décision aujourd'hui a été prise parce que le Conseil estime qu'un taux directeur à 5% reste approprié. Il est encore trop tôt pour penser à le baisser. Selon les données récentes, la politique monétaire fonctionne essentiellement comme prévu. Mais on s'attend à ce que la progression de l'inflation soit graduelle et inégale. Et il y a encore des risques à la hausse. Le Conseil veut voir l'inflation fondamentale continuer à baisser de façon durable. Before taking your questions, let me take a moment to discuss how the economy is evolving. Global growth has slowed and inflationary pressures have continued to ease. The U.S. economy also slowed but has remained surprisingly strong even as inflation has continued to decline. In Canada, economic growth has come in somewhat stronger than projected in the January MPR, but the pace remains weak and below potential. Growth in the second half of 2023 was close to zero, allowing supply to catch up with demand. Labor markets have continued to ease gradually. With employment growing more slowly than population, the labor market has come into better balance. Job vacancies have returned to more normal levels, and the pace of hiring has been modest. Wage growth has been in the 4 to 5% range for some time now, but there are now signs that wage pressures may be easing. CPI inflation eased to 2.9% in January. This largely reflected lower energy prices, an easing in food price inflation, as well as weakness in semi-durable prices like footwear and clothing. But shelter price inflation remains elevated and is still the biggest contributor to overall inflation. More broadly, underlying price pressures persist. Our preferred measures of core inflation eased in January, but remain above 3% on a year-over-year and a 3-month basis. As well, the share of CPI components rising faster than 3% declined, but is still above the historical average. Looking ahead, we continue to expect inflation to be close to 3% through the middle of this year before easing in the second half. Gasoline prices are expected to continue to add volatility to inflation in coming months, and shelter price pressures are likely to persist. In other words, the path back to the 2% target will be slow, and progress is likely to be uneven. Governing Council also discussed the risks to the economy and inflation. Risks to global energy prices and transportation costs related to conflicts remain elevated. Domestically, inflation could prove more persistent than expected. We don't want to keep monetary policy this restrictive for longer than we have to, but nor do we want to jeopardize the progress we've made in bringing inflation down. Governing Council remains concerned about the persistence of underlying inflation, and we want to see further deceleration in core inflation in the coming months. We remain focused on the indicators of inflationary pressures that we've mentioned before. Demand pressures have eased, and the economy now looks to be in modest excess supply. With the labor market coming into better balance, we are looking for further evidence that wage growth is moderating. Before our April decision, we'll also get new information on corporate pricing behavior and inflation expectations. We'll be looking for the frequency and size of price increases to continue to normalize, and for short-term inflation expectations to ease further. We've come a long way in our fight against inflation. Monetary policy is working, inflation is coming down. But it's too early to loosen the restrictive stance of policy that has gotten us this far. Low, stable inflation is a cornerstone of shared prosperity, and we remain resolute in our commitment to restore price stability. And with that summary, Senior Deputy Governor and I would be pleased to take your questions.
Okay, thank you, Governor. Let me quickly remind everyone of the procedures here. We've got close to a dozen reporters here in Ottawa at the bank, as well as a few on the line. I'm going to start here in the room. We'll ask everyone to please limit yourself to one question to make sure we can get to every outlet. If I forget to do so, please state your name and affiliation. Avant de poser une question, veuillez vous identifier. Et si je ne l'ai pas fait, et comme d'habitude, libre à vous de poser vos questions dans la langue officielle de votre choix. So we're going to start with our first question here in Ottawa, and I'm going to call on Mackenzie Gray of Global News. Please go ahead.
I didn't think I was going to go first, so I'm going to go a little off topic here relative to what I think my colleagues will be asking. But both in the States, Janet Yellen and Jay Powell have both talked about commercial real estate being a potential issue. Jay Powell said it's a manageable problem, but he's worried about some banks having issues there. In the Canadian context, how concerned are you about that being an issue for the economy going forward?
We work with our other federal partners that monitor the financial conditions in Canada, so OSFI in particular. So we've definitely got our eye on commercial real estate. The market in Canada is not the same as in the U.S. A lot of the commercial real estate is held by sort of mid-tier banks. In Canada, the exposure to commercial real estate spread more broadly. We also haven't seen some of the sort of reset in valuations that we've seen. So it's definitely something we're watching closely. We've got our financial stability report coming out in early May, and we've started to work on that now. And this is definitely an area we're taking a deep look into, so you can expect to hear more from us.
Okay, let's stay down here with Najuda Al-Maliz from Canadian Press, please.
Hi, Governor. I'm wondering how much shelter price inflation is playing a role in your decision to continue holding your policy rate.
Najud, look, housing's a big part of the economy. It's certainly something that Canadians are very focused on. And so, yes, shelter price inflation, it's the biggest contributor to inflation right now. It's certainly weighing on our decisions. Having said that, our target is for total CPI inflation. And if you look beyond shelter, we are seeing that underlying inflationary pressures persist. And one way to look at that is if you look at our measures, our preferred measures of core, CPI trim, CPI median, those exclude the things that are going up the most and the things that are going down the most. So most of the shelter components are in the things that are going up the most. So they're excluded from those core measures. Those core measures are still running over 3%, around between 3 and 3.5%, and that's true on a 12-month basis and on a 3-month basis. So what's that telling you is that, yes, shelter is the biggest single contributor to inflation, and it's certainly impacting Canadians. But there are other underlying inflationary pressures beyond shelter. And we're looking at everything together, and I think we've been quite clear. We're looking for further evidence of sustained downward trend in underlying inflation.
Let's go to the back now, and Promit Mukherjee from Reuters News Agency, please.
Good morning, Governor. This is Promit from Reuters. I wanted to ask you that the federal budget will not be tabled until after your next policy decision. Will you be comfortable lowering rates before you know the government spending plans?
Well, look, we'll take our April decision in April, and we'll look at all the information we have. Yes, we won't have the federal budget when we get to the next decision in April, but we have a decision every 6 or 7 weeks, so we'll have it at the next one.
Bon, maintenant, passons à Olivier Ferrand-Boissé du Réseau TVA.
Oui, bonjour, Olivier Ferrand-Boissé de TVA. Merci de prendre nos questions. Il y a le directeur parlementaire du budget qui a publié un rapport hier qui estime que le taux d'inflation reviendra à la cible de 2% à la fin de l'année. Et selon lui, selon cette prévision-là, on pourrait commencer à avoir une baisse des taux à partir du mois d'avril. Je me demandais si, selon vous, cette évaluation-là, elle était juste.
Vraiment, les questions au sujet de leurs prévisions, c'est pour le directeur parlementaire du budget. Nous avons publié notre prévision en janvier. Et comme j'ai souligné ce matin, il n'y a pas eu de grandes surprises depuis janvier, donc nous n'avons pas une mise à jour de cette prévision, mais surtout pour l'inflation, on anticipe que ça va rester près de 3% durant la première moitié de cette année, et puis dans la deuxième moitié, on anticipe que l'inflation va baisser de façon graduelle. dans ces prévisions, probablement, on ne sera pas à 2% vers la fin de l'année. Notre prévision en janvier, c'est que cela arrivera en 2025. Le message, c'est que vraiment, on fait du progrès, mais quand on regarde, et on anticipe de faire encore plus de progrès, mais le message, c'est à court terme, le progrès va être lent et l'inflation sera en dents de scie. Il y a des pressions qui viennent du secteur du logement, il y a des fluctuations des prix de l'essence et cela va avoir un impact sur l'inflation dans les mois à venir.
Okay, let's now go to Mark Rendell from the Globe and Mail, please.
Hi there, Mark Rendell here. Thanks for taking the question. In the past 2 months, the Bank of Canada relaunched its overnight repo operations, recommenced the Receiver General auction. Does that suggest that the quantitative tightening program is nearing an end? And could it be wound down earlier than previously signaled in late 24, early 25?
Well, let me make a couple comments on that one, Mark. Yeah, as you highlighted, towards the end of the year and in January, we did do a series of overnight repo operations, lending typically about $5 billion overnight. And we were doing that because the overnight rate was moving up. There was upward pressure. It was moving above the targeted overnight rate. When we take monetary policy decisions like today, we decide on the target for the overnight rate. It's been 5% for some time now. And we were seeing in the market there was some upward pressure. So we came in to relieve that pressure. We did those overnight operations 13 times in January. We haven't done any since January. And that really reflects the fact that that pressure has gone away. As you mentioned, more recently, the government has also restarted Receiver General auctions. That does provide some extra liquidity. Those are up and running. The uptake hasn't been super strong. So again, what that's suggesting is those pressures have gone away. So coming back to your question, we don't think QT was the root cause of these overnight pressures. And you shouldn't take this tightness that we saw in January as a suggestion or as a sign that QT is likely to end earlier than we previously expected. Do you want to say a few words about why we think that pressure we were seeing that pressure?
Yeah, I mean, our sense is where that pressure was coming from was as sort of later in January, markets kind of settled into the view that central banks were likely to cut rates soon, and that pushed the demand for long bonds up. A lot of participants were purchasing those long bonds on leverage, so the demand for funding was up sharply for a stretch of time. So as the governor said, it's not our read that has a lot to do with our QT strategy. Our view on our QT strategy hasn't really changed significantly. We've said from the beginning that we're going to be transparent and predictable. So the bonds on our balance sheet are going to roll off as they mature. The maturity schedule is something you can see on our website. So far, QT has gone very smoothly. Our balance sheet is about 40% smaller than it was when we started QT. So we expect to continue as we planned. Certainly, if that changes, QT is something that we reflect on at every rate decision, and it shows up in our press release, and the governor talks about it in his opening statement. So if our view changes, if our strategy is going to change, we'll definitely give advance notice of that.
And just to do a little pre-advertising, our colleague Tony Gravel will be giving a speech on our balance sheet management in a couple of weeks. So he'll have a little more to say at that time.
Okay, let's now turn to Raul from Epoch Times, please.
Yes, thank you for taking my question. I wanted to ask about maximum sustainable employment, and I believe it was last July that the bank published that chart in the NPR, and so I want to ask how the bank is approaching trying to achieve maximum sustainable employment while fighting inflation, and would pursuing maximum sustainable employment more proactively suggest cutting rates sooner based on how presumably those labor market indicators have worsened since July?
A couple of things, Raul. First of all, our target is for 2% CPI inflation. And yes, we certainly do look at the labor market and, in general, 2% inflation and achieving maximum sustainable employment go together, because if you're not at full employment, you don't have enough people working, you don't have enough incomes, inflation's going to fall below. If you're above it, the opposite happens. There's going to be a lot of upward pressure on wages and prices. We were in a situation that the labor market was very overheated. You could see this across a whole range of measures. Labor shortages were at very elevated levels. The wage growth accelerated sharply. If you looked at vacancies, they were very low. What we've seen is that those things, the labor market has come back into better balance. Vacancies were not low, they were very high. Vacancies were very high. They have come down. They're actually now at more normal levels. The unemployment rate, which was at virtually an all-time historic low, has moved up. It's still relatively low. Wage growth, which had been running at 4 to 5%, has begun, there's certainly some early signs that it is beginning to ease. That is something we're looking for, some continued moderation so that wage growth comes more into line with productivity growth and our 2% inflation target. If you look at the labor market indicators overall, and we have a detailed page on our website which provides a wide range of indicators. Can't really summarize the health of the labor market in one indicator. But if you look at them overall, what you see is the labor market's come into much better balance, and employment growth has slowed. It's been below the rate of population growth. That's been needed to allow supply to catch up. We've needed some time to let supply to catch up. That's brought the labor market into better balance. And the second thing I'd say is that so far we've brought inflation down a lot without a recession, without a large increase in unemployment. The labor market adjustment has been relatively gradual, relatively smooth, and we've moved from a very overheated market to a better balanced market. And our hope is that we can continue to achieve further progress on low inflation without causing any major disruption to the economy.
Go to Jordan Gowling from CTV, please.
Good morning. You said there are upside risks to inflation that remain. Can you expand a little bit on what those risks are and which ones are you most worried about?
So there are clearly some global risks. You're seeing the attacks in the Red Sea. Those are impacting global transportation costs. The Panama Canal doesn't have enough water, so traffic is very slow. So far, so those things have increased transportation costs. So far, the effect has not been very large. And they're obviously, with the global conflicts we have, there are obviously risks that oil markets could get disrupted, oil prices could go sharply higher. Again, so far, that has not happened. But I think certainly the risk is out there that these things escalate. I certainly hope that doesn't happen, but that could happen, and that would have certainly higher energy prices, higher transportation costs would feed quite quickly into higher inflation if that were to materialize. Domestically, the risks really come down to the persistence, or sometimes as economists we use this word, stickiness of underlying inflation. We are seeing a gradual easing in underlying inflationary pressures. The risk is that that stalls and you don't get back to 2% inflation. And that's why we're really looking for continued or further and sustained evidence of downward momentum. We don't want inflation to get stuck materially above our target.
Let's go now to Randy from Bloomberg, please.
Hi, Governor. You noted surprisingly strong growth in the U.S. How does a scenario of a no landing in the U.S. impact your decision?
Well, I mean, the most direct effect is, stronger U.S. economy means that demand for Canadian exports is stronger. We have been surprised, actually now really for the last couple of quarters, in the strength of the U.S. economy. U.S. growth, just to be clear, it is slowing, but the whole path has been higher than we and I think most people expected. And so other things equal, that is probably creating stronger demand for Canadian exports. When you take the Canadian economy as a whole, though, growth through the second part of last year was close to zero, and that has given supply the opportunity to catch up with demand. We now think the Canadian economy is in modest excess supply, and that is one of the things that is giving us more confidence that rates are high enough, and has shifted our discussion to not whether we need to raise them any further, but how long we need to hold them where they are.
Okay, we've got 3 questions left here in the room. First, I'm going to call on Greg Quinn from Market News.
Good morning. Some economists have felt that the bank's core inflation measures may have become a little bit misleading. Are you satisfied with how they're working out, or do you think there's a case to maybe in the short term think of a downside inflation scenario or come up with a new core measure of inflation?
Look, we are comfortable with our preferred measures of core inflation, but let me highlight a couple things. First of all, we've been using this term underlying inflation. And I think the reason we've been using that term is underlying inflation reflects what we're seeing in a whole range of indicators. And so we're trying to make sure people don't get fixated on one number. Yes, our preferred measures of core inflation are important. They're very prominent. We put a lot of emphasis on them, and we've been very clear we're looking for further and sustained easing in those measures of core inflation. But we also look at alternative measures of core inflation, so-called exclusionary measures, CPI-X food and energy, CPI-X. We're also looking, and I think we mentioned it in the press release, at the whole distribution of price changes. And one of the things we're seeing is that still about 45% of the CPI components are rising faster than 3%. When you're at 2% inflation, that number is usually 20 to 25%. So it's still about double what is normal. And coming back to Naju's question, that is one of the indicators that there's still some broad-based inflation. There is still some underlying inflation in the system. So when we talk about underlying inflation, we're looking at all those things. We're also looking at the balance between demand and supply. We're looking at wage growth. We're looking at inflation expectations. We're looking at corporate pricing behavior. And what we're looking for really is consistency across those indicators. We're going to become more confident that inflation is clearly on a downward track if those things are moving down and there's a high degree of consistency across them. So, I mean, coming back to, yes, we need to look at, all the evidence we have. Our core inflation measures are certainly prominent, but we're looking at a broader range than simply those.
Let's go to Paul Vieira from the Wall Street Journal now.
Governor, are you keeping rates? You've signaled that you're not discussing rate relief at this time. Are you trying to keep rates at an elevated level to coincide with the spring home sales season and ensure that activity doesn't pick up too quickly in housing and put further upward pressure on inflation?
Well, Paul, I think, look, the message is it's working. Inflation's coming down. We're making progress. The other message, though, is that Governing Council's judgment is that we need to keep the interest rate where it is so that monetary policy keeps working and we continue to make that progress. Yes, there will come a time when it's time to cut rates. Our deliberations, leading to this decision, it was clear, there's a clear consensus at Governing Council that that time is not now, and there was a clear consensus to hold the policy rate at 5%. Coming back to the housing market, we did highlight in the monetary policy report that there are some risks that the housing market could reaccelerate. In our own projection, we've seen, if you look at the contribution of housing to activity, it's actually been negative. You've seen sharp slowing in that sector with the increase in interest rates. That has certainly lowered demand. If you look at our own projection, our January projection, you'll see we expect some rebound in housing. So we built some rebound in to our projection. That, could that rebound be stronger than we have expected? Yes, it could, and that is an upside risk. But as I said earlier, we're looking. There are other risks. We're looking at the balance of risks overall. We're not targeting the housing sector. We're targeting inflation, and we've got to look at the whole economy.
And our last question here in the room goes to Kevin Carmichael from The Logic.
Governor, you described the biggest source of inflation as shelter. The central bank has provided a pretty good explanation or story for why that's the case. I wondered if you could dig in on what the source might be to explain sort of the second or third biggest sources of inflation that's spreading across the economy that you see that continues to persist. What's your best explanation for why so many prices seem to be elevated despite the obviously weakening growth we're seeing in the economy?
Well, Kevin, the first thing I'd say is I don't think there's a big puzzle. I think monetary policy is working largely as we expected. We raised rates very rapidly. We've held them at 5% since the summer. Growth has weakened. Growth in the second half of last year averaging close to zero, just above zero. So the economy is still growing, but barely. And that has allowed supply to catch up. And that is relieving price pressures. And, you can see that. You can see that in our core measures. They have come down, yes, gradually. Prices do, inflation is sticky. Many prices are sticky. It does take time. There are lags in the effects of monetary policy. If you look at the distribution of price changes, I mentioned that 45% of the CPI components are rising faster than 3%. That was 80%. Even a month ago, it was over 50%. So that has come a long way down. It's not back to normal yet, but it has come a long way down. So, it would be great if this worked faster. This would be great if it was less painful. But unfortunately, monetary policy, it does work slowly. And when you think about it, you raise rates, it takes time for that to impact households. It takes time for their decisions to adjust. It takes time for companies to adjust their pricing decisions. It's not surprising when you think about, it is an indirect channel. It's got to work through the economy. It takes time to do that. There's always a little bit of uncertainty how quickly or how slowly that's going to happen. In some parts, I'd say at the beginning, it looked like it was happening a little more slowly, then it kind of sped up. I would say now, it's pretty much it's working pretty much the way you'd expect it to be working.
Okay, we're going to go to the reporters who have joined us remotely now. I'm just going to remind you on the line to come off mute only to ask your question, then please go right back on mute as soon as you finish so everyone can hear your response. Our first two are going to be Peter Armstrong from CBC, followed by Max Sato of Mace News. So Peter, please ask your question.
Hi, Governor. Peter Armstrong here. I'd like to ask a question on the importance of providing forward guidance as we move through this phase into whatever the next one is. You have some really clear language in both the statement and the decision that it's still too early to consider dropping rates, that you don't want to keep monetary policy this restrictive longer than you have to, but you don't want to jeopardize the progress. I wonder what your sense is as we move into the next sort of round of decisions, how much forward guidance you think you'll provide. Do you expect to see that language change before you actually move rates, or do you think that you'll just get straight to cutting without providing that level of forward guidance? Thank you.
Peter, one of the advantages of putting out our own forecast, and we've provided some at least near-term update today, is that we're very clear about what we're seeing in the data. We're clear about how we expect it to evolve, and we're clear about the indicators that we're watching. So as the data comes out, I think everybody's going to have a sense of, well, is that coming out roughly in line with the Bank of Canada's expectations? Is it coming in stronger? Is it coming in weaker? So I think, even if we're not out there giving new assessments, the market, Canadians will be able to see, are things evolving broadly as the Bank of Canada expected or not. With respect to giving forward guidance, we don't give forward guidance on our forward guidance. So, I can't really predict what we're going to say at our next meeting and how much guidance we're going to give. I think it's fair to say that, in giving indications of where we think things are headed on interest rates, we want to give Canadians as much information as we have, but we also don't want to give a sense of false precision. Right now we're in a difficult phase in the monetary cycle. We've held interest rates at 5% since the summer. It's working. We're seeing progress, but we need to see more progress. We've been clear about what indicators we're following, and I think that will help everybody. I think we'll all be able to recognize the progress when we see it, but we can't put it on a calendar. We are taking each decision one meeting at a time, and look, we know everybody'd like to see lower inflation and lower interest rates. So would we. But as you said, we need to balance the risks of keeping monetary policy this restrictive for too long against the risks of lowering prematurely and jeopardizing the progress we've made. And so that is what we're very focused on.
Okay, now we're going to Max Sato of Mace News, followed by Barbara Schechter from the Financial Post. Go ahead, please, Max.
Thank you, Governor. My question is about stock market performance in the U.S. and Japan, elsewhere. We've seen record heights recently, but there's a concern that this can be a bubble. And do you think that's going to make your policy making more challenging going forward?
Well, I mean, the stock market is something we watch generally financial conditions. We've noted the same thing you have. There does look to be sort of some exuberance in equities. We're not really in the business of forecasting stock prices. I think in general what the markets are doing is the same thing you're all doing here today, which is trying to understand when we'll see a pivot to lower rates. So we'll continue to monitor it.
Okay, next up is Barbara Schechter from the Financial Post, after which we'll go to John Ehrlichman from Bloomberg BNN. Barbara.
Yes, I just wanted to pick up on a couple of threads from earlier in terms of the spring. We could have a combination of, you've talked about possibly a stronger, it's been stronger in some respects than people were expecting already, and then the government budget season. So what I'm wondering is if those two things come together and you know, a strong housing and government spending, what will that mean in terms of your sort of outlook and your progress? Will that have an impact?
Well, you're getting into the somewhat hypothetical range, so it makes these questions difficult to answer. But you know, if everything else in our projection was the same, and housing was stronger and government spending was stronger, growth would probably be stronger, and there'd probably be less downward pressure on inflation. And so that is something we would have to take into account when we consider our interest rate setting.
Okay, now we'll go to John Ehrlichman from Bloomberg BNN, please.
Thank you. Governor, as you noted, you have policy decisions every 6 to 7 weeks, and that a time will come when it will make sense to cut rates. If you do eventually make a decision to loosen monetary policy, how might you think about the frequency of rate cuts or the pace of rate cuts? In other words, is there a scenario where we see a period of both rate cuts and pauses, especially given the challenge with persistent inflation?
Well, you're getting a little ahead of yourself here. And, you know, when we get to that point, we'll have more to say. Look, I think it's, you know, I think it's very safe to say we're not going to be lowering rates at the pace we raised them. I think I expect, you know, we're gonna, when we get to that point, we're gonna have to be thinking. I mean, yes, there are really two questions. You know, when do you decide that it is appropriate to cut, and then when you're there, you're going to have to start thinking about the pace. But why don't you let us get to the first one before we get to the second one?
And our final question today is from Alicia Sikirska from Yahoo Finance. Please go ahead, Alicia.
Thanks so much for taking my question. Governor, you said you need to see further and sustained easing in core inflation. So is it fair to say that it's not enough to see core inflation remain steady at its current rate, and that you need to see the first part of that statement, that further drop going forward? Can you just talk more about what would satisfy the bank on that front?
Yes, I mean, core inflation. Why do we care about core inflation? The reason we care about core inflation is that by stripping out the volatile components of CPI inflation, it gives you a sense of where CPI inflation is likely to settle. The target is total. That's what we fundamentally care about. But there are things like gasoline prices that fluctuate quite a bit, go up and down. So we're trying to see through those to see where the trend is. So, I mean, right now, our preferred measures of core inflation, year over year, running trim and median are 3.3, 3.4. If you look at them on a 3-month basis, which gives you a more timely measure of where they might be headed, they're running at about the same rate. So we do need to see further easing in core inflation, and you know, what you want is, you know, 1 month doesn't make a trend. You need to see, you know, a few months to, and going back to some of the previous questions, we're not just looking at the preferred measures of core inflation, we're looking at a whole range of indicators, and you want to see some consistency across those, that they're, the more that are pointing in the same direction, the more confident you become that, yes, those underlying inflationary pressures really are easing off.
Okay, and that concludes today's press conference. Thanks to the governor and the senior deputy governor, and to all of you, including Dominic, for joining us today. Thanks very much.
Thank you.